Welcome to our YouTube live, and this is going to be one of the last ones, I think, before we reach 100,000 subscribers, and obviously I'm very excited about that. And so if you possibly could subscribe if you haven't already, whether you're watching this live or as a replay, then please do subscribe because it helps us, and we are very close to 100,000. We're just at 91,000 at the moment, so not many more of these before we reach 100k, and there'll be even less if you subscribe. And hopefully we'll do it before Laura's birthday, which is on July the 13th. So that's what we're hoping.
Oh yeah.
Okay. So yeah, we're not far from 100k, and it is a bit of a signal moment for a YouTube channel. Even though an absolute number doesn't really matter, I think it is quite exciting. And I think, you get the plaque and everything, and obviously we're not going to stop at that point, but it'll be very exciting for us anyway. Couple of videos we've done this week, one which has already gone out live on YouTube, and another one which hasn't yet. I just shot it, haven't edited it yet. That joy is yet in store. The first one was on high inflation investing, how you can allocate if you've got a high inflation environment, which asset types particularly do well in that kind of environment and how you can position for it and profit from it. And then the video I've just done today is about overheating of the economy, because I certainly think that's a risk, more so than inflation, just overheating and too much risk, people taking too much risk because of policy, both monetary and fiscal. So I think that'll be an interesting one. I'd like to hear what you think of it. Obviously, I'll see that in the comments. So please do comment, because we do read the comments, particularly the ones which aren't cryptocurrency spams, because it's just nice to get the feedback. Portfolio challenge, I'm going to launch that again this quarter. Now, the idea behind this is that everybody who's a Patreon member gets to take part, and Patreon supporters just fill out their portfolio at the beginning of the quarter, which they think will give the best risk-adjusted return. So that'll be the return divided by the volatility of their portfolio. So you can't just take a hugely risky portfolio, it's got to perform well as well. So it's number of units of performance, return, divided by the number of units of risk in terms of volatility. Generally, those are best if they're diversified. So that's what makes it challenging, I think, to get a good risk-adjusted return. And so that'll be for Patreon members, and there will be a Patreon post which is linked to in the description, I believe.
Not yet.
Which isn't yet, but will be in the description if you watch this in replay. And then you'll be able to sign up on Patreon if you aren't already. And there'll be a spreadsheet on Patreon, which I haven't yet released, which I'll do in the next day or so, where you can enter your own portfolio, and then I've got scripts which load it up and work out the return and the risk. It's a lot of challenge, a little of fun, I think. Oh yes, what do you win? Laura said, good question. You win a free...
The cash equivalent of a 3 years...
The cash equivalent of a 3 years free membership of Patreon. So you'll get your Patreon year subscription free if you want it. Although the person who actually won this year very kindly gave it to a dog charity. So Teddy was very keen on that, weren't you, Ted? Yeah. So that's the portfolio challenge. And so let's start the questions now. If you put a question on and you're one of our YouTube supporters, you get pushed to the front of the queue. We know because you've got the little crown next to your name on the comments. So Laura will flag it and I'll answer it. And if you do a super chat where you have to pay some nominal amount, then you also get pushed to the front of the queue. So obviously the super chats help us. YouTube members help us because that way, provides a source of revenue for us. It means that we can carry on running the company and eating, which is always a boon. And yeah, also like and subscribe if you possibly can, because that helps us too. Because the subscriptions are very close to 100k now, and that would be great if we can push it past 100k. Right, back to the questions, and I think we've got one person who's already supported us on YouTube, which is really kind. Stephen Jones, thank you very much for that. He's now supporting our independence, which is great. And do we have any members? No. Okay. So first question is from Rushar, who I recognise. Nice to see you again. And the question is, do you think there's still a chance that many companies will default after the ultra dovish stance of the Fed will be reduced? The question, I guess, is whether there's going to be a big pickup in defaults. Now, generally, when you're a credit strategist, you look for things called maturity walls, as in brick walls. But the idea with a maturity wall is, are there many bonds which are issued with a similar maturity date, such that they all mature on the roughly same date? And all of those companies have to approach the market again to roll over their debt. So that can potentially be a problem because it brings huge supply into the corporate bond market, which demand may not meet. And that could widen credit spreads, increase the cost of funding, and create higher defaults. So the question at the moment is whether there's a wall of maturities, and I believe there is. And when we reach, I can't remember the exact date of it, unfortunately, off the top of my head, but I believe it's in the next 6 months. And I think that if the Fed does withdraw some of the liquidity from the markets, so for example, slowing down the asset purchases, I think they're a long way from raising interest rates at this point, given where unemployment is. But if they do start to reduce the asset purchases, there could be a jump up in yield, or we could get another jump up in yield due to just growth being surprising on the upside. That also tends to increase yields. And of course, the funding cost for a company is the risk-free rate, which is the treasury yield plus a credit spread. So if the yield increases, the risk-free yield, that's a problem for all corporates. And of course, we've already seen a tripling of 10-year yields since August last year. We've gone from 0.5% to over 1.6%. And that's obviously going to affect funding costs for any company that rolls over its debt. But the question is, I guess, whether we're going to see a huge number of defaults. I think that's unlikely. The reason being that economic growth is strong and employment, although it's still reasonably high, unemployment is still reasonably high, it is improving, and that's going in the right direction. So I think certainly from this point in the cycle, I think we're late cycle with an interruption due to the pandemic and fiscal stimulus, which has helped us because it had to, and now it's helped us more than it really had to in the US. So I think in the US, it's unlikely we're going to see a huge wave of defaults because of that tailwind from the fiscal stimulus and also good economic growth. But the question is then what happens a year after that? Because once the fiscal stimulus fades, and we had a huge amount of debt issuance last year, in the last, I think it was Q3, some of that will be maturing next year. So the question is, what's going to happen then? Is there going to be continued strong growth, or is it going to fizzle out? Will the Fed raise rates, and will that trigger a default storm? So I think at some point there will be a reckoning, but I'm not sure it's going to happen in the next year or so. I think it'll probably be beyond that now, given that financial conditions are pretty easy and credit spreads are still very tight at the moment. But certainly I think it will happen. I just think it's a question of when, and I think it'll probably take longer now because of the stimulus. Okay, next question is from Jumpin' Kiwi. Good handle. Hi Ramin, does a SIP have a compounding advantage over an ISA if the government is topping up the value at the start of the investment rather than starting with an after-tax amount? I guess that's true. Because if you put £100 into an ISA, the assumption is that you're a basic tax rate payer and you immediately get grossed up by 25% because you've paid 20%, so you get grossed up by 25. So when I put 100 into my SIP for a demo video, I ended up immediately with £125. And so, yes, that's going to compound more over time than if I'd just put 100 into an ISA because the monetary amount was more. So yeah, by boosting the initial amount, then yes, it helps. Unfortunately, many of us put money into our SIPs later in life. We shouldn't, but we do. And that has the opposite effect. Obviously, time is more important than the amount, I'd say, because that's a geometric increase, and time is, I guess the amount is linear. So, but still, yeah, you're right. I think it does make a big advantage of putting money into a SIP from the compounding. Yeah, good point. Oh, there's a question on Slack, and let me just open that. Okay, and the question is, oh, here we go. One from Gary. If crypto is digital gold, then shouldn't it be regulated by the CFTC? Okay. Well, firstly, I don't think it's gold. I'm not saying it's a bad thing, crypto, but I am saying that it's not like gold in many ways. Firstly, the volatility, massively different. The correlation to risk assets, massively different. In a sell-off, just look back to what happened in March last year, you'll see that crypto sold off more than equity, whereas gold kept its value. So that was a very different behavior. So in a risk-off environment, crypto will probably sell off, whereas gold usually keeps its value. So that's one big difference. Then the other big difference, I guess, is the I guess it's going to be something like, it's been around for longer, so it's more proven store of value, gold. But the only similarity I'd say is they're both wasting assets. They don't generate an income, so neither has a fundamental value. It's just what people are willing to pay for it. But in terms of, inflation hedge, neither is a very good inflation hedge. Neither is a very good equity hedge. But I'd say gold is probably better than crypto. But it really depends on the type of crypto. I mean, if you look at stablecoin, for example, that's essentially cash, and that would be a good equity hedge. So it depends on the type of crypto. Plus, you get some cryptocurrencies which actually compound over time if you lend them out. So things like comp, for example, would be one example of that. So for them, perhaps you could work out some kind of discounted value. Unfortunately, you get paid in the cryptocurrency itself rather than cash, so hard to price. Yeah. So it's all assuming it's fairly circular, the pricing, because you're paid in the note itself or in the token itself, so difficult to price. But should it be regulated I think it will be regulated more heavily in future. I think it's pretty clear that people don't want it to be used for tax evasion, and they are going to clamp down on trying to hide pockets of wealth in cryptocurrency. Obviously, that's just a sign of it growing up, which is a good thing. People shouldn't be using it for that anyway. So I think heavier regulation is on the cards. It's almost inevitable, but that's just a part of an asset class growing up. And there will be shakeouts along the way, but as long as people still believe in it, it'll still have value. It's just a question of how strict the regulation is and whether it's an existential threat to the cryptocurrency. Those are the worries, I think. And I guess the other big difference is that you don't need proof of work for gold. You just need a vault, which doesn't require much energy. That's a massive difference between gold and some cryptocurrencies, which do require proof of work. Interesting article in the FT today talking about how in Iran they've had power blackouts. So they've had to stop people from mining cryptocurrency because it was using so much energy that the actual grid was being taxed beyond its limits. So, yeah. Okay, so let's move on to the next question. One from Stephen, another supporter. Thank you, Stephen. In fact, Stephen's the one who's just joined us as a supporter on YouTube. Do you think New York will continue to be the main world hub of the economy, or will it move to other financial centres around the world? Do you think it's moving faster from the pandemic? Really interesting questions. It's certainly true at the moment that New York is by far the biggest financial hub. And I think that's likely to stay for some time. I think eventually what's going to happen is it will move to the east. I think things like the Shanghai Stock Exchange and the Shenzhen Stock Exchange, those are probably going to pick up the mantle in terms of volume, because GDP will inevitably drive Chinese equity to higher market cap, and just the numbers game will ensure that more market cap means more liquidity, more trading, and volume will move east. I don't think there's any question about that. It's just a question of the speed at which that happens. So I think it's not going to be for several years, but it will happen at some point. But I think the pandemic hasn't really sped up that move in terms of a shift to the east, because it hasn't massively increased Chinese market cap relative to US market cap. Not yet. It wasn't the pandemic that was responsible for that. The pandemic hasn't had much effect. In fact, if anything, the US equity rally has made the US larger in terms of market cap. But I think it's inevitable that will happen. And then, you get this kind of halo effect where if a company wants to list its stock, it'll be crazy not to list it in, Shanghai as well as New York. Just in the same way that, the UK is kind of really a distant second to New York now. But, 100 years ago, you had to list on the UK stock exchange, and then New York was a kind of backwater. But of course, these things change. And it's inevitable that New York star will fade slightly in preference for China. I think that's inevitable. Okay, next question. Good question, that one. I liked it. I had a very interesting question from Patreon supporters this week about which involved the investing in commodities which would benefit from the ESG shift for alternative energy, because it had lots of physics in it. And that was really fun to research. I love physics, so that's why I enjoyed it.
Someone in the Slack channel.
Oh, there's a Slack channel question, Laura says. Right, Arsenio. Hello, Arsenio. Nice to hear from you again. Arsenio, who's one of our supporters, says, hello, Ramin. What is your vision in 10 years from now on blockchain technology beyond cryptocurrency, such as smart contracts, yield farming, and more generally, decentralized finance? I think adoption by central banks is going to be a big deal. So, for example, Ethereum is an interesting network because it's effectively a kind of substrate for computation, and you can have smart contracts which run on Ethereum. And if central banks start to adopt something which is similar, then the adoption of that for other uses will probably increase. But I think one of the difficulties with decentralizing is efficiency. So I think as long as they can work out how to do these transactions efficiently, and I think the trust issue is pretty much solved, but I think the energy issue really isn't. I think that's got to be addressed. And I know there are kind of proofs of work which don't depend on energy. Proof of space, for example, is one alternative. But ultimately, I think the successful decentralized networks will be the ones that solve the energy problem, because many of the investors in crypto are the same ones who, usually quite young people who also invest in ESG, and really their conscience won't sit comfortably with something which uses large amounts of energy. So I think that has to be solved. Ultimately decentralized computation, there's no question that that's important. So there are aspects of blockchain, which is its decentralization, massively parallel computing, but these are questions which transcend blockchain. This is more about efficient computation and building trust. So blockchain kind of addresses both of those. So yeah, I think that in 10 years, it's likely that we will have more of those types of application. But I think for many applications, there'll still be the reliance on central trust and rule of law and efficiency from centralizing computation. So, for example, I think central banks are unlikely to decentralize their contracts. I think that's unlikely because the whole concept of a central bank is in the name. You know, the idea that it's central and the trust lies with one entity. Also, it's very efficient to do computations on something like a SQL server. You know, it's much easier than doing things in parallel. You don't have to think about the order in which computations occur. That's one of the difficulties with parallel computation. So I think for many applications, blockchain just wouldn't be appropriate. But for others, yeah, I think blockchain could be used for things like crypto, maybe for things where you don't want a centralized system, where people are worried about central control. But I think at the moment, it's hard to think of what those would be. And the fact that there aren't that many applications which have proved successful beyond crypto tells me that it's really a technological solution that doesn't have many uses so far, which kind of questions its validity. Still, you know, we'll have to see. But I certainly like the kind of yield farming idea. As long as there's demand for the tokens, you know, I think yield farming is an interesting idea. But again, I'd say the problem is that you get paid according to tokens which have, you get them paid the most in terms of yield for the tokens for which there's the biggest demand for borrowing. So that's itself predicated on the demand for the token. So if that token demand disappears, then the yield farming use case also disappears. If you could get paid in real money, fiat, for holding a currency, cryptocurrency, well, that would be great. I think that would be much more attractive for many people. But at the moment, that just wouldn't be viable, given the volatility of the contracts, which tells you a lot in itself. Okay, next question is from Jack, who is also a supporter, Jack Lemasson, who says, thanks for your valuable insight. If Reit is one of the best performing assets in all scenarios of inflation and pays so much dividends, what's the risk or downside of owning more of them? Okay, let's have a look at a Reit, and I'm going to share my screen in just one moment so you can see what I'm seeing. Just log into SharePad so you can see this and share my screen. I'll move my face down here. Right. So let's have a look at a Reit, and so let's have a look at British Land. And so here we go. This is British Land, and we'll look at the chart for British Land. This is a UK Reit which buys property in the UK, so it's commercial property in the UK. And if we look at the summary for the company, you can actually see that retail is a big part of it. So 310 million is retail parks, office space is 270 million. And if we look at the revenue, you can see that recently the profits have fallen, the revenue's fallen, the profits have fallen. If we look at the EBIT, and obviously that's going to be a difficult time for them. So it's certainly linked to the economy, and it's certainly been affected by the shutdown. So it's certainly not a kind of risk-off asset. It's definitely a risky asset, and it's very tightly linked to GDP usually. So I think even if there's high inflation, although this is real assets, the problem is that if inflation is very high, you tend to have smaller disposable income in society. So households will have smaller disposable income. They've got less money to spend in the shops, and that tends to reduce the earnings of things like shops which are in retail places, companies which have to lease office space, have to cut back. So this kind of filters through the economy. So it's certainly not true that if inflation is very high, REITs would not be affected. They would, because that's a drag on earnings and it'll be a drag on the economy and on REITs. So there is a drawback. If inflation is very high, then REITs will be affected. Equities affected as well. Equity sells off at very high rates of inflation for the same reason. So it's certainly not an inflation hedge. Just like equity, it's an inflation hedge as long as it stays within about 2 or 3% of the peak, which would be around 2%. So if you get deflation or very high inflation, equity sells off, and so would REITs. So I don't buy the idea that it's an inflation hedge, even though it's a real asset. And it's certainly a risky asset. So you don't have to look at many of these REITs in order to see that they're linked with equity. There's a very high equity correlation. So yeah, I don't think it's kind of like a panacea by any means. What it does provide is a very safe, safe in the sense of regular income. So if you buy a REIT at a fairly low price after a sell-off, that's when it's most attractive, because then you'll get a bigger yield and it's a better entry point as well. Whereas if you buy during the peak of a market cycle, you'll overpay for it. Generally, the capital gain will be smaller or even negative, and your yield may be cut if the REIT becomes unprofitable. So, yeah, I'd say there are definitely risks with REITs. So just as with equity, you diversify across sector, you diversify across country with REITs, which you can do quite easily. And that way, if a particular country or sector gets whacked by something like a pandemic or a recession, then you're not going to be negatively impacted as much. So it's pretty much like investing in equity in that sense. So it's definitely a risk-on asset. It doesn't diversify equity much. If anything, it increases your risk within a country or sector, and so it pays to diversify, I'd say. That would be my view. Right, so back to the questions. So yeah, please do like us. Also, as I said earlier, we've got very close to 100,000 subscribers. So please do subscribe, because we would love to have 100,000 subscribers by Laura's birthday, which is July the 13th. Plus, Teddy will not eat until we reach 100,000 subscribers. Sorry, Ted. Over here, my friend. Over here. That's it. Very good. So that poor cockapoo will starve. Starve, I tell you, unless we reach 100,000 subscribers. Isn't that right, Ted? Oh, sorry, mate. And I'll torture him, obviously. Oh, I'm sorry. Yeah, so please do subscribe. Help us reach 100,000. It would be great. And also like, because that helps us too. So please do like the video. Right, next question. Do we have one on Slack? Okay, so actually Jack says he's in Canada, so he'd have the REIT and tax exempt accounts. That's good. But it still has these risks of being linked to the economy, to GDP, and also having a fairly high volatility. So it's certainly not a riskless asset, and it certainly would be affected by inflation. But if you get it in a tax exempt account, then you get the double benefit of the income. Because I should have said, REITs are a very efficient way of collecting rent on commercial property, because the deal is that if a company sets itself up as a REIT, it has to pay more than 90% of its rental income to its shareholders. And if it does that, it doesn't pay corporation tax. So from your point of view, it's a very tax efficient way to receive income from commercial property. That's the beauty of a REIT. That's one of them. So that's I should have said that. But yeah, risky nonetheless. Okay, let's answer a few more questions on the channel. So the next question is from Rohit, who says, oh, I've scrolled down too far. I'm thinking of buying a home in the next 3 to 4 years. What could be the best option to save for down payment when even short-term bond ETFs are showing no or negative return these days? I think you have to be realistic about the kind of returns you can receive in 3 to 4 years while taking some kind of risk. In this environment, the return you get for low risk investments is just close to zero. It's not zero, but it's close. So, short duration government bonds are probably the safest thing. If you push it up the risk spectrum a little bit, maybe you could get some kind of short duration credit fund. PIMCO is one asset manager that manages such funds, but there are many others. And that way you'll certainly earn a bit of extra money because of the credit spread. But if you take too much risk, then there's always the risk that within 3 to 4 years you get a drawdown and the house that you thought you could afford is now a house you can't afford. And you don't want that to happen. So as usual, there's this kind of risk reward trade-off. Now, if you could invest for longer, then, you're not so worried about volatility. But if it is 3 to 4 years, that's a very short period for equity. And, that's a lifetime, multiple lifetimes in cryptocurrency. So, you shouldn't really put your currency at too much risk if that's your goal. Really, there's no way around it. If you want a safe deposit, then you don't want to take too much risk in terms of duration or credit. So, and certainly not take too much equity risk. So I don't think you have many choices, unfortunately, Rohit. So yeah, you're going to have to just put more down payment in and not get much interest, I'm afraid. Sash Media says higher. Nice to see you again. Oh, interesting. BMBM365 says, what do you think of the performance of the AIM index over the last 10 years? So let me just pull up the AIM index. Here we go. So if people aren't familiar, let me just pull up that index first of all. Indices. One sec. Okay, let me share my screen so you can see this. Okay. And we're going to go for AIM. Well, there are sector indices for AIM, but let's just go for the entire AIM index. FTSE. Well, here's the AIM 100, and this is going back to 2005. And you can see that, it isn't great. It's been pretty much flat over that period of time, so not very impressive. And if we look at the AIM All Share, which looks at all market capitalizations, then again you can see it's been fairly flat. Recently it's been on a tear because UK small caps have done very well. So if we just zoom in on the recent period, obviously if you get good strong economic growth, the AIM index is small caps, and small caps tend to do well when economic growth is strong, and this is no exception. We've seen a very strong rally recently, but that's why I'd kind of manage your expectations. Once this boost in return is over and the boost in GDP is over, after the pandemic kind of ebbs away and the euphoria ebbs away, I wouldn't expect a huge return for AIM in future. So over the last 149 trading days, it's up 29%, so very strong returns, but already you can see that starting to level off. So I would be cautious about that. I'm not sure what you think about that. Is that why you asked the question? Because you're unimpressed with the returns? I'd like to know. Anyway, so let me switch back to full screen. There we go. Right, so back to the questions. We've got another question from a supporter, one from Gary. Gary says, can you please explain if the Fed eventually changes its extra dovish stance, will there be a tantrum in emerging market equity? I live and earn in India. My government has no dollar denominated debt. Yeah, I think certain bits of the capital markets in India are fairly safe. For example, the government bond space is safe because that's not open to, or at least it's not, I think it is open to some foreign investors now, but that's a recent change. So as you know, will there be a massive demand for EM equity if interest rates increase in the US? Certainly not as much as now. And also sovereign debt in emerging markets, there'll be less appetite for that as well. Now, this often comes with emerging market crises as the Fed tightens its policy because people have less demand for risky investments, and that would include emerging market equity as well as sovereign debt. And that often increases the cost of capital in emerging markets, and companies which are over-levered may suffer defaults, banks lend less, and you often get these credit spirals which are triggered by Fed policy. So certainly at the moment we're not seeing any signs of that at all because the Fed is still thinking about raising rates. But at some point I think there will be a pullback in risk appetite for emerging markets and frankly for every other type of risky asset when the Fed starts to tighten. The biggest shock will come if the Fed has to slam on the brakes. And that would happen if there's unexpected inflation and the Fed doesn't have time to signal that it's going to be raising rates. It has to suddenly act and act very forcefully to stop risk assets getting out of control or to keep inflation under control. So I think those are the kind of, that would be the biggest shock in terms of tantrum if there's an unexpected policy move by the central bank, by the Fed. But as long as they signal it well ahead of time, I think what we'll get is lots of mini tantrums and ultimately EM will be much less affected. But, it depends on the country in EM that we're talking about. Certain parts of EM are very different to others. For example, China is EM, but it's a very different beast to, say, Peru or Thailand or any other EM country. So I wouldn't be worried about China in particular, but I would be worried about some of the smaller EM countries if the Fed tightens policy. But I think India may be affected because there could be some flows out of the Indian equity market. But again, that's more of a domestic market anyway. So I think India will be affected to some extent, but not hugely. And as I say, for the government debt in India, it's mostly domestically owned anyway. And it's good that India has no dollar denominated debt. Compare that with Turkey, where huge amounts of their corporate bonds are issued in US dollars, and a lot of their sovereign debt will also be affected because that's hard currency debt as well. So if their currency devalues a lot, it's always a problem in terms of debt servicing costs. So yeah, I think for those countries which have a lot of hard currency debt as a proportion of their total debt, that's going to be a problem. Another question from a supporter, which is from Dave C. Interesting one, actually. I recently read that any long-term outperformance by active fund managers is attributable to factor exposure and not their stock picking ability. Do you know whether this is true? Unfortunately, I don't know whether that's true. I did used to work on a system which actually calculated the stock picking alpha, how much outperformance is generated by stock picking, how much from currency, how much from factors, for example. But I'm not aware of any research that shows that to be true. What I am aware of is what I read in SPIVA, which is the S&P Index versus Active report, which shows that generally the rate of success is very low, net of fees, and in particular sectors it's even poorer. But whether it's due to factor exposure or stock picking, I don't know. I haven't seen that decomposition myself. I suspect it's true. What I also know is that it doesn't tend to persist. Active outperformance doesn't tend to persist, which makes choosing an active manager very difficult. But if it was due to factor exposure, then I would expect that it would persist. So let's say that growth is a style which outperforms. And let's say that someone like Cathy Wood, which goes very heavily towards growth as a factor, outperforms. That wouldn't persist beyond the growth outperformance period. So what we've seen recently is that Cathy Wood's funds have massively underperformed over the last quarter. And if that's the case, then that suggests that it was factor exposure which made her outperform. It wasn't necessarily the stock picks which outperformed. So I think the lack of persistence for outperformance suggests that it is factors which do the outperformance. Maybe. I don't know. I'm not aware of any kind of research on that I've got access to. But if you have any research that you have access to, which you're willing to tell me about, I'd love to know. I think that would make a great video. And I think other people would find that interesting too. So if you've got that Dave C, please pass it on. If you can dig out the reference that you originally found it on. Okay, let's move on. And please do like our stream and our channel and subscribe, because we're trying to reach 100,000 subscribers before Laura's birthday on July the 13th. So that's our goal, 100,000 in 2 months, a bit less than 2 months now, isn't it? So that would be a great birthday present for Laura, and I'd like it very much as well. That would be great. Right, back to the questions, and there's a question from Andrew Lester, who says, he just says happy birthday Laura for the 13th. That's very kind of you, Andrew. And Yuvraj says, thanks for the wonderful education on investing. It's my pleasure. What's your view on locking down current mortgage rates in the UK for a 5-year term versus going for a 2-year cheaper rate? So really, this is a question about whether we think interest rates are going up between the period between 2 and 5 years from now. I think they probably will, certainly in the next year or so, because of the fact of greater growth. We've had a recent lull in growth. We've had a lot of stimulus from the UK government, not as much as the US, but certainly the furlough schemes have helped us through this period. And I would expect a bit of euphoria on the other side. And if that's the case, then you'd get a little bump in growth, and that will increase yields. But I think it's still the problem that structurally, that means over a long period of time, that's strategists speak for long periods of time, then interest rates do tend to be lower than they were in the past. So am I worried that interest rates are going to go back up to 10% or 15%, or that inflation's going up to 15%, or something crazy like it was during the Volcker period? Not really. Because I think many of the demographic reasons why yields are low, and that's a long-term thing, are still in place. Those kind of structural factors, aging demographic is one of them, that tends to keep interest rates at fairly low levels. But maybe growth will surprise on the upside. Maybe there'll be some new technology which is discovered, which makes us suddenly more productive. But while we have this kind of lowish growth, aging economy, where there's not huge innovation, it's difficult to see very strong growth. And combined with that, interest rates would stay low. So personally, I wouldn't be too worried about interest rates shooting up. But certainly I think in 5 years, they'll be higher than they are now. But not a lot higher. So it really depends on how much cheaper it is, the 2-year versus 5-year. But yeah, that's just my tuppence worth. Right, MJ Pierce says that it would be good for the winner to donate their winnings. This is talking about our competition, to see our fantasy portfolio competition for Patreon supporters. The person who previously won, they gave their money to a dog charity, which Teddy was very grateful for. Dog Tears, I think, was the charity, which looks after Many Tears, which is looking after dogs which have been mistreated and raised on these puppy farms. And Teddy approved of that, didn't you, Ted? Oh, yes, and incidentally, Ted won't be fed until we reach 100,000 subscribers.
Stop it.
No, that's not true. I'd rather starve myself than not feed Ted. So next question is from what are your thoughts on the best way to enhance returns? Private equity, EM equity, small cap, etc. Well, now leverage I wouldn't go for. I say that. I'm experimenting with a portfolio at the moment. You'll probably see more about that later. But generally, I wouldn't say that leverage is a good idea, because that can really hurt you in a downturn. Private equity, I think the difficulty with these lottery ticket type of investments is, such as private equity, is that people overpay, and that generally means smaller returns over a long period of time. So that's my worry with things like private equity. EM, there'd be a small premium, a lot less than people think. Dimson, Marsh and Staunton, who are the people who wrote Triumph of the Optimists, a very good book about long-term returns across different asset classes, they expect that the extra risk premium, the income return you'd get from equity in emerging markets versus developed, would only be about 0.5% per year. That seems very low given the huge growth difference in GDP terms, but that's due to the dilution effect that you get with more equity issuance in economies which are growing more quickly. So the same amount of earnings are distributed amongst more companies, such that if you own an index, you end up owning less of the total income which is generated by the economy. So that's the dilution effect, which is fairly well researched and documented. And that's probably why EM, even though it's growing a lot faster in terms of GDP, that doesn't translate into equity gains in many cases. So yeah, I think EM is probably not a good way to go. Certainly at the moment, I think, what looks most attractive in the countries where we're seeing a pickup in activity, certainly over the next 6 months or so. So that would be Europe, including the UK, the US as well to some extent. Small caps are a good way to go because they give you exposure usually to domestic earnings. So that would be an interesting way of boosting your gains. Also, I think what's recently been the case is that value has outperformed. So small cap value might finally be coming back into the swing that it's had for the last multiple decades. And, that's been hugely out of favour for a long period of time. So small cap value might be something to consider. And certainly if you run back tests going back many decades, the one factor that comes out again and again is small cap value as a factor which just outperforms fairly consistently over many decades. It's only recently, over the last 5 or 6 years, which it's really underperformed. So that might be another thing if you believe that that's going to be something which comes back into fashion. But otherwise, I guess something like high yield credit. It's funny because people don't really talk about high yield credit, but even now it's earning about 4.5%, even though credit spreads are very tight in the US. If you're going to be holding on to equity for decades, holding on to high yield and earning that 4.5%, And particularly buying into high yield credit during a crisis when it becomes very cheap. Not single bonds, of course. You'd buy a fund like HYG or JNK, but that's a good way to earn a fairly high return, but from income. And so if you are investing for decades, I think for young people, it makes a lot of sense to have some high yield credit as well. You won't get much capital gain, but you will get money from the income. So I'd say those are probably the ones which I'd consider. The other thing you might consider is something called yield enhanced funds, where you're selling the upside by selling call options. So these are sometimes called buy right strategies, and you can buy those in the US very easily. There are many of them. A fund we talked about last time here on the YouTube Live was QYLD, which is the NASDAQ, but with 12% dividend yield. Now, how do you achieve that? Well, you sacrifice the upside. So if there is a very strong rally in NASDAQ, then you don't participate in that because you've sold that upside. But if the NASDAQ trades sideways or moves down a little bit, you can be better off with one of those funds because it boosts your income. So your total return can be very good. And it's best for indices which are very volatile. So an absolute dream would be a cryptocurrency fund which is a buy right, because the volatility is crazy. It's over 100% in some cases, but you'd miss out on the upside if there was one. So that might be an interesting thing. But I mean, we haven't even got ETFs on crypto, so that's not going to happen anytime soon. Is MJ Pierce the guy I went to school with? Are you Michael Pierce? Are you Michael? I don't know. It'd be great if you were. Anyway, the next question. Do we have one on Slack?
Yes, we do.
Oh, right. Slack question.
It's a super chat.
Oh, thank you. This is from Ali Mahebian. Thank you very much for your super chat. And the question. Oh, and also thank you, Thomas Crew, for supporting us on YouTube. We appreciate that. But Ali's question is, how risky is it to be all in commodity stocks? Ride out the commodity boom. Very risky, I'd say, because the volatility of commodity tends to be high for a start. The other kind of aspect of commodities is that they tend to be affected by very short-term factors which quickly rise and fade. Let me give you an example of that. In fact, I published a research note when I used to work at an investment bank, which was mentioning this kind of thing. But for the research for that note, I looked back for these commodity indices over a very long period of time. And what was great about them was that sometimes they just did incredibly well. So, for example, there was a point in time, I think it was in the 70s, where there was a wheat embargo such that Russia stopped shipping wheat to North America, and as a consequence the price of wheat increased massively, and there was just an incredible return on wheat at that point in time. Another example that we're all familiar with recently would be swine flu, and there was diarrhea in pigs, and that pushed up the price of pork, and again, we had huge rallies in pork prices. So I think that's great, but there comes a very rapid turnaround with that kind of crisis, where suddenly there's a resolution of the bottleneck and the price plummets. So, for example, let's look at soya. Just quickly, I'll just share this with you because I think this is kind of interesting. So let's look at soya. Now, this is an ETF. Oh, no, it isn't. So soy, maybe the ticker is SOY. Yeah, here we go. Yeah. So here's a fund which gives you access to the price of soybeans. It's issued by Wisdom Tree. There are many others that do the same thing. But just look at the return we've had recently with that soybean fund. So this is a massive rally, and that's occurred since the beginning of July last year. And you can see that the price of soybean is up about, well, over 70% over that period of time. But the problem with these kind of rallies is this, which is typically it comes with a lot of volatility, and then you get these very rapid turnarounds where the bottleneck is solved, the price plummets, and it plummets very quickly. So this is a 93 trading day period when the price of soybeans fell by about 30%. So the difficulty is getting out in time. And if you have a very large allocation in just one commodity, or even a group of commodities, the risk is you don't get out in time. And it's very unlikely that you would get out in time unless you have some kind of inside knowledge about that commodity. So, for example, recently I had a client that was specialized in trading cocoa futures. And even for them, it was very difficult to call which way the cocoa market was going to go. They knew all the traders, they knew all the people involved in the market. They knew about the crops, about weather in the regions where cocoa is grown, about demand. So they had this really interesting conversation with me about what drives cocoa demand, which was just fascinating. I just absolutely loved it. But even they didn't really know which way that market was going to move. So I think it's very unlikely you'll be able to time things correctly. So again, it comes back to not being able to time these things. If you do have a rally, sometimes the momentum persists for some period of time, but you've got to be nimble to get out quickly. So if you can put a stop loss in, maybe you could do that because that way you'll limit your losses once you've got a certain gain. But I think it's a difficult way to invest. It requires a lot of work. You'd lose a lot of sleep in case you didn't get out in time. I think it's much easier to invest in, a diversified portfolio and just leave it. So for many people, I don't think that's a good way to invest. But it's fun. You can have a view. You'll probably be wrong. You'll probably lose money, but it could be fun for a small part of your portfolio, but certainly not a large percentage, I'd say. Right, how are we doing for time? We've got 2 minutes. So let me just quickly just say again, please do subscribe because we're trying to get to 100,000 subscribers by Laura's birthday on July the 13th. And that would be great. If you're watching this in replay, you can still subscribe and do like our stream because it helps us obviously. And we are launching another fantasy portfolio competition for Patreon supporters such that you've got to get the best risk-adjusted return over the next quarter with a fixed portfolio. So it's good fun. We kind of monitor it from week to week to see who's in the lead, and the winner gets a free membership of Patreon with PensionCraft for a whole year, or they can donate it to charity if they want to, which the previous winner did. Okay, so one last question and then we'll wrap up. Do we have any on Slack?
No.
Okay, so I'll randomly choose one. Not very random because it's Lennart, who I very much like. Lennart von Nebelschutz, who says, sorry about my umlaut pronunciation. Good evening, Ramin. Thanks for your hint on crypto. Went back on it after years, and being a nerd myself, I'm interested in it now more than ever. Read the Bitcoin Standard, read the Bitcoin Standard, and I'm in with 5% now. Yeah, I've got some cryptocurrency now. I've got some Ethereum, and I lost some money with Ethereum, but I didn't sell. I'll hold on to it, and I'm trying to educate myself about it and learn about decentralized finance, but also, what kind of technology it's built on and what gives it value. So yeah, I've been reading up on that, and I've certainly got my own views on it now. And I think the best way to learn about something is firstly to have an open mind. I've learned that from Gino O'Shaughnessy, and also to have skin in the game. And by losing money with cryptocurrency, I've learned a lot. I think it's interesting. And that's why I made that video about diversification, because I think it is possible to diversify even in cryptocurrency. And a lot of the lessons from standard asset allocation with boring old equity and bonds applies equally to the crypto world. Diversification, buying non-correlated crypto, all of that increases your risk-adjusted return. And so I think that's kind of a good lesson. Also, buying when there's a crash. If you buy after a crash, then obviously you get better entry points. Right, so I think we'll leave it there. It's 8:01. Thank you all for joining us. As I say, liking us helps, subscribing helps even more, because we are trying to reach 100,000. And it was great to have your questions, incredibly good questions as always. I'm sorry if I didn't answer your question, but if you become a Patreon member, we have calls like this every 2 weeks, and we get through almost all of the questions. In fact, it's very rare we don't answer them all. And you also get access to Slack and our community, so you can ask questions anytime you like, which a lot of people like. And it's a much more interactive experience. I can't really talk to you via this experience because, I can only oversee your questions and I can't see all of them. Whereas on Slack, you can message me anytime you like. Anyway, thank you all for joining us. It's been great. It's been great fun. It's always great fun. I hope you found the answers useful, and we'll see you again in 2 weeks. So have a great 2 weeks, everyone. Bye-bye.